Okay, let's review out of your book, problem 4-17, and it is another transaction recording. So we're going to do the journal entries that occurred during the first year of operations for Kissick Company. It says, A, they issued 200,000 shares of $5 par value common stock for $1 million in cash. Well, if we are going to be receiving $1 million in cash, we know cash is an asset. The only way to increase an asset is with a debit. So we will debit cash for $1 million. And then we are going to credit common stock. This stock happened to be issued at par value, 200,000 times $5. So we have no additional paid in capital here. All the proceeds get credited to, sorry, I'm missing a zero here, get credited to common stock. Then they borrowed $500,000 from Ogilvy Bank and signed a 12% note due in 2 years. Well, again, when we borrow money from a bank, our liabilities are going to increase. This is a note, so we're going to credit notes payable. That's how we increase liabilities for $500,000. In exchange for signing that note, the bank's going to give us a check to put into our bank account for $500,000. So we'll debit cash $500,000. C, incurred and paid $380,000 in salaries for the year. So we paid $380,000 in salaries. That means we need to credit cash. Cash decreases with credits. And in exchange, we paid our salaries. So we'll debit salaries expense, $380,000. Let's look at D. Purchased $640,000 of merchandise on account during the year. So merchandise is an asset. Assets increase with debit. So we'll debit merchandise inventory, $640,000. And we'll credit, we purchased it on account. We're not paying cash. We're going to have to pay for it later. That's a liability. So we credit our accounts payable, which increases that by $640,000. E says we sold inventory costing $580,000 for a total of $910, all on credit. So if we sell merchandise on credit, means we're not going to receive the cash. We're going to get an IOU from our customers, $910,000. We call that accounts receivable. That's an asset. It increases with a debit. And we'll credit our revenue. Where is it here? Sales, $910,000. Okay, and then we need to take it out of our inventory. So we credit merchandise inventory for the cost of that merchandise, which is said was $580,000. And we debit cost of goods sold. Something happened there. Let me try it again. Okay, that increases our expenses, cost of goods sold, which actually decreases our equity. How about F? We paid rent of $110,000 on the sales facilities. So if we pay, anytime it says pay, cash is a credit for $110,000. And we debit our rent expense. How about G? Purchased $150,000 of store equipment. Well, we could stop there. If we're buying store equipment, we know we're going to debit equipment, $150,000. That increases the assets we bring into our building, things we own. And then we paid $50,000 cash and agreed to pay the difference within 90 days. So again, anytime we pay cash, you should know we credit the cash for $50,000. And the difference will be an IOU, which is an accounts payable, for $90,000. How about an H here? We paid the entire $100,000 owed for store equipment. Oh, did I do 90? Yes, see, I would have messed up. My debits wouldn't equal credits here. So $100,000 we're going to pay. So we know we debit accounts payable because we just credited it here. We want to get rid of that. And we'll credit cash because we paid that entire amount. Also says that we paid $620,000 of the amount due to suppliers for credit purchases previously recorded. So let's change that amount. We're going to change that to $720,000. My mistake. I got in a hurry. Okay. How about I? Incurred and paid utilities expense of $36,000 during the year. Well, if you pay it, we credit cash, $36,000. And then the debit is to what? We bought utilities expense, so we'll debit utilities expense, $36,000. How about J? Collected $825,000 in cash from customers during the year for credit sales previously recorded. So that means we would have received an accounts receivable from those customers. Now we're collecting the cash. So we get to debit cash for $825 and credit the accounts receivable, $825,000. Let's look at K. At year end, accrued $60,000 of interest on the note due to Oglesby Bank. Well, what that means, we've incurred the interest, we haven't yet paid it. So we can debit our interest expense here for $60,000, and we'll have to credit our interest payable. Now we show a liability that we owe on that interest that we've already incurred. And then L, at year end, accrued $10,000 a past due December rent on the sales facilities. Okay, so means we need to go ahead and record the rent expense. That was for $10,000. And we credit, in this case, our rent payable because we've incurred it, but we haven't yet paid it. We need to make sure we show that we still owe that money, that $10,000. Let me check my work really quickly just to make sure we did everything right. And yay, we did. Thank you.